Are we starting? Are you recording?
Yes.
Okay. Hello, everyone. Welcome to Seminar 6. Today, the seminar is about behavioral finance, and me, Jason, and Megan will be doing the presentation.
So, what is behavioral finance? It's a field of study focused on how psychological influences can affect the behavior of an investor, and it always results in an effect on the market. This science proves that investors cannot always think rationally and can be influenced by bias. So, why is understanding behavioral finance important? It can help us avoid making decisions driven by emotion that will ultimately lead to losses. It also explains the difference between an investor who has efficient rational behavior and normal behavior, which is more driven by emotion.
Oh, the volume isn't working. That's fine. We'll just skip it then. So decision-making bias and errors include self-deception, where people who tend to limit their learning abilities because they believe they think they know everything already. This explanation is pretty self-explanatory. Heuristic simplification, which is a bias associated with people who consider incorrect or adopt a wrong behavior to arrive at a decision. And a simpler way of explaining this is basically using a shortcut to arrive at a decision, such as process of elimination, trial and error, etc. And onto social influence, which is decisions largely impacted by our peers, which may include investment in a stock because most of our friends or peers invested in it. And an example of this is when a large group of people earlier this year decided to invest in GameStop due to a social trend, even when it wasn't doing well. And lastly, emotion, how our moods, anger, happiness, ecstasy, etc. affect our decision making. And some common behavioral finance biases include overconfidence / illusion of control. Overconfidence bias is a tendency to hold a false and misleading assessment of our skills, intellect, or talent. Self-serving bias, which is a tendency in behavioral finance to attribute good outcomes to our skill and bad outcomes to sheer luck. Confirmation bias, which is the tendency of people to pay close attention to information that confirms their belief and ignores information that contradicts it. Herd mentality, where in behavioral finance, it means the investor's tendency to follow and copy what other investors are doing. And loss aversion, which is a tendency in behavioral finance where investors are so fearful of losses that they focus on trying to avoid a loss more so than on making gains.
So now we're going to talk about the Robinhood scandal and controversy. I'm sure most of you know what Robinhood is, but I'm still going to explain it a little bit. So Robinhood is a commonly used platform for stock trading in the United States. And what Robinhood did is they banned trading of GME and AMC. So obviously the traders are quite mad because they missed out on opportunities to make a profit with those stocks. Robinhood was then accused of manipulating the market by restricting trades. So what they did, restricting the trades, caused the stock prices to go down, which made Reddit investors lose a lot of money, and hedge funds who are betting against the stock make much more money. So why did GME and AMC go back down? So GME and AMC went down over 80% in a few days. The main reason is because of the Robinhood restrictions. So retail investors could not buy into GME and AMC, which means that demand was very low and that dropped the price. Another reason is because lots of investors started to sell at the very high price because they're satisfied with their profits. And when people start to sell, the supply goes up. And since the demand is already low, the price dropped even lower. So the lesson is don't be greedy. Now we're going to talk about traditional theory vs behavioral theory. So these two finance theories are quite different. So in traditional theory, they make lots of assumptions. They assume that both the market and investors are rational. They care about utilitarian characteristics. So you only care about your own opinions, not other people. So you won't get influenced by people around you. Investors have self-control, and investors are not affected by cognitive or information errors. So basically, you won't process any information wrong and make the wrong decision. Now, the behavioral theory is much more realistic. So they treat investors as like normal people, not always rational. And obviously, people have limits for self-control. They are influenced by biases, affected by cognitive errors that will lead to a negative result.
So how can you overcome these behavioral finance issues? You can use reflective decision-making while establishing a logical process to make a decision and be more focused on the process rather than the outcome. You can prepare, plan, and pre-commit, be informed, and disregard personal decision-making, and do not rely on gut instinct. So we have some reflection questions for you guys. Just feel free to type your answers into the chat based on the information we gave you during this presentation.